The free market theory is one of the fundamental cornerstones of modern economics. In this video, I want to talk a little bit about the free market theory and where I think that it might have gone wrong a little bit. The free market theory basically states that corporations will govern themselves efficiently. You don't need as much regulation or oversight. I think that there are many elements to the free market theory that are valid, but I also want to talk about some of the problems that have emerged over the last 10 to 20 years. And this is certainly an area of great debate, but I think that it's something that a lot of people should at least understand the basics of. So let's first take a look at some of the checks and balances in the system. Everything starts with the shareholders of the company. Now, shareholders of the company are people like you and me. We own shares of stock, and that's basically buying a share of the company's future profits and returns. Now, we can't manage the company on a day-to-day basis. After all, we have jobs of our own. So we hire a board of directors to do this for us. The board of directors' job is to select executives of the company and to figure out how much those executives are going to be paid. The executives of the company then run the company on a day-to-day basis in the goal of generating profits for the shareholders. So if the executives aren't doing a good job, the board of directors can fire them. And if the board of directors is not doing a good job, the shareholders can fire them. Seems pretty good on paper, right? Well, here is what the problem was. Over the last 10 to 20 years, a lot of the incentives for executives and employees for that matter became very short-sighted. The emphasis was on short-term performance, quarterly performance, or yearly performance, not on long-term performance over 5 to 10 to 20-year periods. And I'm going to show you why that's important with a couple of examples. Let's start with the example of the day trader. The day trader works at a major Wall Street firm, and his compensation is 40% of all profits that he generates in a given year. So let's start with 2007. In 2007, the day trader generates $10 million in profits. Pretty good year. 2007 was certainly a boom year. So, what's the result of this? Well, he gets $4 million himself. $4 million goes to the trader, and $6 million goes to the firm. So far, so good. This seems great, right? The firm and the shareholders have made a $6 million profit, and the trader has made a wonderful $4 million for himself. But now let's move on to 2008. Now, we all know 2008 was a miserable year for the equity markets. In 2008, the day trader actually loses $20 million, so negative $20 million in profits. So what's the result? Well, the result is $0 for the trader. I mean, 40% of negative $20 million is zero. I mean, you can't take away money from him, and that's part of the problem. And negative $20 million for the firm. So the firm has lost $20 million on this. Now, here is where it gets interesting. Let's take a look at the average yearly payout for the trader. If you average 2007 and 2008, the trader has made $2 million per year. $4 million in 2007 and zero in 2008 is an average of $2 million a year. And the firm has lost an average of $7 million a year. Remember, they lost $20 million in 2008, they made $6 million in 2007. So a total $14 million loss divided by 2 is $7 million loss per year. As you can see, this is a real problem. The trader has taken home a huge, staggering amount of money on an annualized basis, but he's actually lost money for the firm. So you see here how short-term incentives have created a major problem. You think this is limited to the world of Wall Street? It's not. Let's go back 10 years and take a look at the dot-com CEO. Now, the dot-com CEO's compensation is 10% of Bubble Technologies stock. That's the company that he is currently running. So let's move on to 1999. In 1999, the company, Bubble Technologies, goes public with a market cap of $1 billion. Remember, the dot-com boom, everything was trading at really high rates. Now, so the CEO of Bubble Technologies has $100 million in stock, and he sells this $100 million and buys low-risk treasury bonds. So now the CEO owns $100 million in low-risk treasury bonds. And you're thinking, okay, so far so good, right? The shareholders have certainly made some money, so why shouldn't he be allowed to sell his stock right now? Well, let's move on 3 years down the road to 2002. In 2002, Bubble Technologies, with a poor business model and very few revenues, goes bankrupt. And the current shareholders lose their entire investment. Again, let's take a look at the payouts. As you can see in this diagram, The CEO's payout is $100 million in treasury bonds. That's what he took off the table back in 1999. The shareholders, on the other hand, have lost their entire investment. Again, short-term incentives for the CEO cost the shareholders in the long run. How can we solve this problem? Well, let's take a look at another hypothetical .com company. In this situation, after the public offering, the CEO must wait 5 years to sell his stock, and this creates a long-term incentive. So what happens here? Now the CEO is thinking, wait a second, I can't sell my stock right away. So instead of going public immediately, the CEO decides to raise more money, develop a profitable business model, and grow the company. And eventually, several years down the road, the CEO takes the company public to long-term success and prosperity. There are several examples like this. One of the notable examples of this is internet payments company PayPal, which went public after the .com bust, had a very strong business model, and ended up getting sold to eBay for $1.5 billion. So as you can see, these long-term incentives can create great returns for shareholders, and executives can certainly make money as well. So what's the big takeaway here? The big takeaway is that you should always think long-term. That is really what it boils down to. Think long-term, because short-term incentives create problems for executives who can make money really fast, take it all off the table, and shareholders will lose their money. And I think that's something that has been neglected in the last 10 to 20 years in both investors' minds and in the world of corporations. Thank you very much for watching. For similar videos, I recommend you check out my website, www.kanjo.com.